Hello and welcome to Invest Like a Guru. This is our new research-based YouTube channel where we'll take up different investment strategies. We'll see if we can backtest them and if we can improve them. And today we will start out with the well-known momentum investment strategy called dual momentum investing. That is invented or thought out by Gary Antonacci, the guy on the picture here. And today what I'll do in this video is I'll explain the strategy. I'll show you some different backtesting results of them, both the original from the book and ours from our research system. And then we'll show you a single variation to it that can actually improve the results. In the next video, also about dual momentum investment, I will show you some further improvement that we have thought out, and we'll see which one suits your investment style the best. Now, first of all, the dual momentum strategy. What is it? Well, it's actually a very simple strategy. The rules are here. They couldn't almost be more simple. What it is it calls it GEM rules here, and that is because this is short for Global Equity Momentum. So the GEM rules here basically ask one question or a couple of questions every single month. The first of every month, the system asks itself, did the S&P 500 outperform the US Treasury bills over the last 12 months? Meaning, did the US market outperform bonds? Well, if it didn't, if the Treasury bills did the best over the last 12 months, then that is a no here. And you will simply just invest in an ETF, the Barclays US Aggregated Bonds here, for instance. So you'll just invest in bonds, keep it for a month, and then ask the same question in a month. When a month has passed, you ask this again, did the S&P 500 outperform the US Treasury bills? If no, well then you just keep the position. But at some point, you will have to answer yes, because then the S&P 500 outperformed the Treasury bills. So yes, the market outperformed, or the stock market outperformed the bonds. In that case, you ask yourself, did the US market, meaning the S&P 500, outperform the rest of the world, meaning the world excluding US equities? If the S&P 500 did the best over the last 12 months, then you buy the SPY, the S&P 500. Keep it for a month and do the exact same routine in a month. If the rest of the world outperformed the US market, then that is a no, and you'll just buy an ETF in the world excluding US equities. That is how simple it is. Did the stocks do better than the bonds? If yes, you choose stocks, and the S&P 500, if that outperformed the rest of the world, then you choose the S&P 500. And if not, you will choose an ETF covering the rest of the world. That is it. Now, can this really outperform the market? Well, if we're looking at the research done by Gary Antonacci here, we can see that over something like 45 years here, back from 71 to 2016, you can see that he has done several numbers here. We have the S&P 500. We have a mix of 60% stocks and 40% bonds. We have some relative momentum, some absolute momentum, and then of course the combination with a dual momentum. Now, as you know, I'm a big fan of momentum strategies, so I'm not particularly surprised that this outperforms the market. As you can see, the S&P 500 in this time span did 10.4% per year. The dual momentum did 16.2%, meaning 6% better. It had a lower standard deviation, a lower volatility. The Sharpe ratio, of course, then was better, 0.92, which is excellent. And the worst drawdown was in the market 50.9%, and in the dual momentum 17.8%. Now, when looking at a strategy like this, it is of course important to know what are the parameters that have been tested under. Because, for instance, the worst drawdown here and the standard deviation is often tested once per month, so at the exit of every month. But there can have been larger drawdowns in the meantime during a month. between the 1st and the 31st. So that is a big thing to remember here when we do these tests, and I have a feeling that the original Antonacci test is done once per month. Now, normally when we are back testing, we are doing this on a day-to-day basis to get a more precise picture of what actually comes out on the CAGR, on the Sharpe ratio, and on the worst drawdown, which is very important. So let's have a look at inside our own testing system what we have actually found out. Let's start with the original strategy here, the dual momentum original gem. Now, it has had a fantastic 2021 up until now. Had you just invested like this, you would have made 18.27% here from the beginning of 2021 and to the mid of December. The CAGR, however, and we are testing back from 2008 and up until now, so that is of course only 13 years, but the CAGR this strategy shows in this time span is quote unquote only 8.41%. That is still a reasonable return, definitely, but it is not the 16% in the original calculation of the strategy. There's also a higher volatility, and that gives us a Sharpe of 0.55. The Sharpe is basically just the CAGR divided by the volatility, and this is just above 1.5, and that is not terribly good. The max drawdown here is 33.7%, and that is of course from the big drop in the market with the COVID-19 last year. Here you can see the drawdown chart down here, and we can see the statistics for the number of winners and so on. Absolutely a fantastic risk to reward down here. Now, if you're looking at it, we have, of course, as always on our platform, we have the monthly performance. You can see the annual out here and how it has differed from our benchmark here, which is not the S&P 500. And we can also see the quarterly performance. We can see that sometimes it takes some really wild drawdowns here. And here you can see the 17.13% here. And you can see some higher here, 19.48% up in Q1, and that is of course with the COVID and everything. What is interesting down here, of course, is if we look at the current positions, we are just in S&P 500. Now, this is one of the weaknesses, if you ask me, in this strategy. It is always 100% invested in just one asset. Now, I don't mind a strategy that always is 100% invested, but having a strategy that is 100% invested in just one instrument might be a bit risky, but that is how the strategy is built. So right now, it's just in the S&P 500. If we're looking at the historic positions, we can see here that from the 1st of July, it has been in the S&P 500. Then it had a single month with a small loss here, where it was in the VEU ETF, meaning the world ex-US. Then there was a couple of months, 1 month here in the SPY. It had a while in the VEU again, and you can see up here it shows the bonds, since that was what the strategy dictated. So that is the original GEM global equity momentum strategy on the dual momentum. Very simple and very well tested, but it seems like it worked better back from the 71 and upwards than it has done so far from 2008 and onwards. Still, 8.4% is not bad, but let's have a look at if we can improve it in any way. Remember that the original rules choose between the US market and the rest of the world. Now, the change we have made here in this variation is if we look at the rules back here, let's just have a look at them. You know that if the market outperformed the bonds, the original model chooses between the S&P 500 and the rest of the world. What we are doing here instead is that, if we just draw an arrow here, that instead of choosing between the S&P 500 and the world, then we choose between the some growth stocks and some value stocks. Let's have a look at it, what we can choose between. Because what we do here is, let's have a look at the stats first, of course. In the other model, we had a CAGR, compound annual growth rate, at 8.41%. And you can ask yourself, is that really so big of a difference, just a couple of percentage points? But yes, if we have a look at the original model here, starting with $100,000, we are ending up in around 309, 10, 11,000, whereas over the same time span, but with a 10.85% per year, you're ending up at 426,000. So that's quite a lot of difference. We can also see the Sharpe ratio is significantly higher, 0.7 instead of 0.55. The volatility is a bit lower, the max drawdown is lower, and so on. This is actually a stronger strategy. We can see the monthly and the quarterly performance here, that we are not having the same devastating quarters as the other ones did. We do have, of course, some quarters with -8, 9, 10%, but we're not having these 20% drawdowns that we saw in the other one. Now, the current position, if we look at that, is the small cap 600 value stocks, meaning, and you should not, this is not 100% negative, of course, but this means that what we can choose between here is the small cap, the US small cap 600 value, meaning here we are choosing value stocks, or if we're looking at some of the others we can choose from, is the S&P 500 growth, meaning that instead of choosing between the United States and the rest of the world, we are choosing between growth and value within the United States. And as you can see, of course, you can also choose the bonds here, but this is the big difference. We are not choosing between the United States and the rest of the world. We are within the United States choosing between S&P 500 growth and small cap value. And that gives us the big difference of almost 2.5% per year since 2005. Now, many investors would have been satisfied with almost 11% in this time span, definitely. However, in the upcoming video, I'm going to show you a variation where we are using our normal strategies and our normal risk on, risk off principles that we use here on Invest Like a Guru, and we can actually improve this significantly. I hope this gave you a good picture of what is dual momentum, how is the investments chosen every month, and how we have improved it. You're always welcome to ask us, just pop us a question below the video, and I'm looking forward to talk to you again in the next video.